I'm Annie Dickerson, and on behalf of Julie Lamb, as well as the whole Goodegg Investments team, thrilled to welcome you to another episode of the Life and Money Show. Now, as you know, here on the Life and Money Show, we talk about all sorts of different things related to personal finance and investing, as well as helping you to create and live a meaningful and intentional life by design. And today we have a really good topic that we're going to talk about, really top of mind. All right, so let's start with what happened. How did this happen, and seemingly so quickly? All right, so here's what you need to know. Silicon Valley Bank provided banking services to nearly half the country's venture capital-backed technology and life science companies, and to more than 2,500 venture capital firms. And this includes major tech companies like Roku and Etsy. And for several decades, while many startups were doing well, Silicon Valley Bank continue to do what many banks do, which is they kept a small portion of its deposits in cash and used the rest to buy long-term debt, including treasury bonds and mortgage-backed securities. Now, in 2021, this is when the beginning of the end, although they didn't see it, nobody saw it at the time. But in 2021, think about what happened, right? 2020, we had just had the COVID pandemic shut down, of course, the government stimulus. So in 2021, we started to see that influx of cash. And so in 2021, Silicon Valley Bank experienced what seemed like a really, really good problem to have. All of a sudden, its clients were flush with cash, again, due in part to the government stimulus, as well as the tech boom right around that time, right? And so due to this surge, the bank's total deposits exploded from 62 billion, which was already a lot, to over 124 billion. Now, while on the outside, this 100% growth seems like the best thing ever. I mean, who wouldn't want overnight your business to double, right? All of a sudden, it doesn't matter what business you're in, right? You sell out of everything, or you all of a sudden have your calendar filled up with new clients, whatever it is, right? Growth always seems like a really good thing. But in this case, because there was this sudden influx of cash, SVB had to figure out what they were going to do with that money. And unlike what I thought as a kid, they couldn't just have, $124 billion sitting there in a vault. So they had to figure out what to do with that. And that led to some of the investment decisions that ultimately led to the downfall. So here's what happened. As deposits grew at this alarming rate, the bank couldn't grow their loan book fast enough to generate the yield that they needed to earn on the capital that they were taking in. So as a result, they made a decision to purchase over $80 billion in bonds and mortgage-backed securities and treasuries, leaving relatively little liquidity. But remember, rates were low at that point in 2021, historically low. And so they had to invest the majority of the money to to even have a shot at making some of those returns to pay out the interest on for all these deposits. So, okay, now let's get back to the story. So, so they had made all these investments in these long-term debts, so debt instruments, right? Mortgage-backed securities, treasury bonds. And while those long-term debt investments were great, while interest rates remained low, they provided steady and modest returns, they quickly lost value as interest rates started and have continued to rise over the last year. And SVB, and we'll talk about this in a bit, they assumed, because the Fed had kept promising they're not going to raise rates, And so SVB took that bet and they said, well, the Fed says they're not going to raise rates. And so they made these investments, but then guess what happened? Of course, the rates went up. And so as the rates went up, those investments quickly lost value and became worth less. Now, this in and of itself normally wouldn't be an issue because the bank could just wait for those bonds to mature. However, this is where the compounding of multiple things comes in. Because there's been a slowdown in venture capital and tech at a broader level, in part due to the rising interest rates. As a result, deposit inflows have slowed dramatically, and clients started withdrawing money because they didn't have that same influx of cash. These small businesses, these startups were hurting for cash. And so they started pulling their money out, which put SVB in a very tight cash crunch. So as a result, they didn't have any choice. They had to sell some of their investments at a loss. And so as of this recording last week, the bank announced that they had sold $21 billion of their securities, incurring a $1.8 billion loss. So then, of course, that in and of itself would not have led to a collapse, but the compounding of events, right? So as the loss was announced, both depositors and investors panicked, leading to a run on the bank, as well as a free fall in stock prices. As panic spread via the Twitterverse, this is actually, I think it was a Wall Street Journal and New York Times announced that this was the first Twitter-induced bank run and bank collapse. But now, right, news spreads like wildfire. So panic spread and depositors rushed to withdraw their funds, which these days is as easy as the click of a button. And so they were able to pull out tens of billions of dollars within a few short hours.